Okay, today is April 7th, 2025, and we are in the midst of a pretty significant market correction. We're having what's, I guess you could call it the Trump tariff effect, and it's been pretty rocky the last several days. And so I've been talking to all of our clients. I've been talking to different people about what's happening, but I wanted to put this little video out here to just kind of encourage you and let you know that even though things are looking kind of bad right now, there still is good news about investing. And I'm going to talk to you about what that good news is and hopefully just give you a little bit of, like I said, encouragement to stay the course, as they say. And as people do say that, I think you also need to have some evidence to back that up. You know, what does stay the course really work? We're going to talk about that, and we're going to talk a little bit about people who try to predict what's going on right now, and I'll just give you, like I said, a little bit of a boost to just remember what your long-term goals are and how investing works, and that there is still good news about investing out there, even though the media probably today is, wanting you to think that the world is ending. So we're going to dive into that and give you some good things to think about when it comes to your investments. All right? Okay, so the good news about investing, that's what we're talking about. And the first thing is going to be that the good news is that it is all just noise. So when you hear people on the news or you hear anybody that's in the prediction business, you have to remember that they are not necessarily in the advice business. And you should tune out the noise and go straight to the person who's helping you. Get that advice directly from an advisor who knows you personally, who can help you with your goals and your, everything that's going on in your life, your financial planning, and not base what you're going to do next on what you're hearing from all the noise that's going on out there. Okay, it's really important, and I can show you, just put a little evidence behind that's true, that most of these predictions don't necessarily come true. So you have to watch out. Here's a bunch of forecasts for 2024 that happened. That's not what's going on right now with the tariffs, but at the end of every year, all these big firms put out their forecasts. There's many more than this. This is just a little sample. But as you can see, the forecasts that happened at the end of 2023 about what was going to happen in 2024 were all over the board. You got all the way down there to JP Morgan being way in the negative, and all the way up there to Oppenheimer being in the positive, but no one even came close to no one predicted even the average was going to happen in 2024, and the S&P pretty much blew that out of the water. So, and then here's just the kind of another look at that, another different way to look at it. In the short term from 2020 to 2024, you can see that again, there in 2024, some of the lowest analysts predicted, things way down in the negative. Of course, the S&P did great. And if you look at that middle range, the blue box, the median estimates there, they never really came close at all ever to what the S&P actually did. And if the one big difference one there is the middle in 2022, most people were saying 2022 was going to be a good year. It turned out to be just a really bad year in the middle of everything that's going on here. We had a good 2020, 2021, and then we had this big downturn in 2022. And then, of course, the last 2 years have been good. So predictions, forecasts, usually wrong, right? And also what happens is the confidence of the prediction changes. So as people say what they think is going to happen, as the market changes and sways, then they'll come back on and say, oh, it's this now, or now we think this is going to happen. So predictions and forecasts and everything, they tend to they go with the flow of the market. So people do try to say what they think is going to happen. People ask me all the time what I think is going to happen. I am not in the prediction business, and that's okay because most predictions are wrong. All right, so just be careful. Like I said at the beginning, get advice directly from someone who's helping you personally with your goals and your portfolio and everything, and tune out the noise that's going on. So good news is it's all just noise, and you can actually do really well with some good advice for your own goals. All right. Okay, so the next thing is that what goes up keeps going up. It's not what goes up comes down. What goes up keeps going up over time, and the market does continue to go up. And of course, if it just trended down, people do say sometimes like, oh my God, how am I going to lose all my money, or the market's going to crash, or it's going to go to zero. That's not reality. If this chart went the opposite way, we'd probably already be at zero. I mean, but that's just not reality. The market does go up over time, and there tends to always be some reason that you can pick why now's not a good time to be in the market, right? And that this chart shows that you got to be careful of that because you could miss what's going to happen in the future. There's all kinds of reasons that you could say we're not good times, right? You can go all the way back there to the 70s, and we had a bunch of, had the oil problems, and we had inflation, and then we have, Black Monday, savings and loan crisis, we have Iraq wars, we have Y2K, we have 9/11, dot-com, crash, subprime mortgage, all that stuff. But during those times, think about the people who just bailed out during all those times. There's no way to recover, right? So just remember, what goes up keeps going up, even when you have these periods that seem like now's not a good time to be investing. And this chart actually shows that a little bit better. You can see that, there are the red periods are the times that tend to be short and pretty steep, but there's not as many. Look at the bull markets. The bull markets are longer and a little bit more extreme on the upside than the downturns are. So all those little red areas, if you were going to bet and say, no, well, I'm going to put my money on the fact that, there's more downs than there are ups, or that the downs, are always worse than the up market. Well, this chart pretty much shows the opposite of that. You can see that the bull markets tend to be longer and getting more return than the short, steep downturns. All right. And then, so if you were to put where we are today at the end of this chart, yeah, you're going to have another little red spot there. But how long is that going to be? It's based on this chart, it's probably going to be short. And then the next up time is going to be another one of these big blue areas. So you really don't want to miss that, right? Okay, let's take a look at another concept here. This is one of the things that gets people very worried about investing and makes them jump out and everything like that, is that, it is a bumpy road. I mean, one of the things that helps people make money in the stock market is volatility. That's what rewards people. And it is a bumpy road sometimes. And if you look at this, you can see though that, that there's an average, they're saying that the average annualized return since 1926 of 10%, okay, for the S&P from 26 to 24. And the yearly returns have ranged from as high as 54% all the way down to 43%. But since 1926, the annual returns have been positive 73 times and negative only 26 times. So there's many more positive years than negative years. But when you look at it this way, if when you see these ups and downs, it can be a little nerve-wracking. But you have to understand that this is just a different view of this. And when you have the perspective of what happens over a long period of time, this constant upward trend of the market, then that other chart that looks real crazy, up, down, up, down, up, down, that could, get you worried or scare people or whatever. But when you look at this chart, it's like, oh yeah, I do want to participate in that. I want to have money invested in something that does grow over a long period of time and rewards, long-term investors. So that's good news. That means that we're not headed, to zero, right? We're headed somewhere higher than this chart right here in the future. Okay, the next thing is that successful investing is not a guessing game. Okay, it's a waiting game. You do not have to guess all the time. Should I be in? Should I be out? What thing should I buy? What thing should I not buy? What stock is going to be, up next? Or what sector do I need to be in? It's not a guessing game. Okay, it's a waiting game. And a few things to show you here on this, that when it comes to bear markets and when it comes to recovering your money from a bear market, a lot of times it's a short period of time. So you don't want to guess, that, when it's this big decline in the market that you should get out, because you're not going to really know how to get back in. And sometimes the return that you get or getting back to where you started can happen in a short period of time. So this chart shows that, 9 out of the last 16 bear markets since 1929, people who stayed the course made back their losses within 1 year. All right. And so you can see what some of those are right there. Look at towards the bottom, in February of 2020, max decline of 34.3%, 94 days, we were back. All right. And there's a bunch of other examples of that here as well. But 9 out of the last 16, money came back within a year. So again, you have to ask yourself, well, where are we now? Okay. So we have a pretty big decline. We had 10% decline in just 2 days. And I haven't looked at the market yet today, but I know that from the beginning of the day, it was down pretty. Actually, it was kind of a weird day. Like started out a pretty steep decline, and then all of a sudden we were in the positive for like a little short period of time, and then it was in the negative again. So we'll see where we end up today. But you do have to kind of ask yourself when you look at this chart. Well, man, look at all those past bear markets in 1 year. People had made their money back. So currently, if you go back, if you look at your portfolio, and this is probably for most people, this is probably the case back 1 or 2 years ago, you still probably have more than you did then because we had 2 really good years. So the next question is, okay, when is the correction here? When do I get below where I started, over a year ago? And then how long to get back above that again? And, history shows here that it could be less than a year before that happens, right? So again, don't want to miss that. You want to stay the course. Here's another example of that as well, is that sometimes, stock gains add up pretty significantly after big declines. So you could have let's look at 3 different periods of decline. You have a 10% market decline, a 20% market decline, and a 30% market decline. And then you have to look at what happened on average, 1 year after that, or 3 years after that, or 5 years after that. So when you had a 10% market decline, which we just had, all right, what's it going to be 1 year from now? Okay, historically, the 1 year cumulative average after a 10-year decline is 11.8%. A 3-year, 34.6, and a 5-year, 68.7. And a 20% market decline, that's even a little bit more significant. The 1 year was 21, 3 years 42.5, and the 5 years 74.9. So you do have your investments can really grow pretty significantly after big market declines. So it's not a good idea to get out when at the biggest decline, because it's going to take so long to get back to where you were. And just holding on, staying the course, this is the proof of that it does happen pretty significantly after declines. Here's another way to look at it. You have an average annualized return. So after a more than 10% decline, the average 1 year rate of return was 11.7. The 3-year average annualized return after more than a 10% decline was 10.3, and after 5, 9.6. So again, staying the course, this proves that you really do want to do that. It's not a decline, and then 1 year later, it's a bigger decline, and then 3 years later, it's another bigger decline, and then 5 years later, it's even more of a decline. That is not how it has worked historically. Pretty likely that is not the way it's going to work with what we're dealing with right now. Okay, the next good news is that the next best day will come, all right? And it might come sooner than you think. Another reason to stay the course and not jump out is that downturns don't necessarily lead to down years. And I'm going to show you several things on this that I think are really important. This right here, this chart right here is, I'm going to make this a little bit bigger for you so you can see it's kind of small. But this chart right here shows the percentage change that happens and ranked by the worst and the best. Okay, so we got the worst ranked down days over here in terms of a percentage change, and the best ranked up days over here in terms of percentage change. And I've highlighted a few of them, but what I'm trying to explain to you here is that you don't want to miss the next best day. Okay, let's look at the number one, 10/19/1987. There's that Black Monday stuff, right? Down 22%. So we've been down 10% in the last couple of days, but this was a 1 day decline of 22.61%. But when was the next best day? Look at that right there, 10/21/1987, 2 days later, a 10% change going up. So you can imagine the jumping out here and how bad people felt when they saw this come, 2 days later. All right, that's not, that would be not good. Let's look at the next one. Here's 3/16/2020. Well, 3/20/24, we're up 11. This one's down 12 and then up 11 just a few days later. 3/12, you're down almost 10%. And then 3/13, you're up almost 10%. And then here's another one right here. Here's a 2008 where you're down 7.87%. And then that's on 10/15. And then 10/21, 10/28, you're up 10% again. So you can see here that you don't want to miss that next best day, because it can happen pretty quickly. And it happened, pretty significantly in COVID. And I can show you just during COVID how crazy. You probably remember how crazy that was. This is the point change that happened, and we had this big drop right there. Same thing on 316, huge drop, and then right here on 324, just a few days later, big up again. 312 to 313 again. Here's 311, and here's 310. Here's 318. All these things happen right there. So if you remember, like that week there, in week to 2 weeks in COVID, it was up, down, up, down, up, down. And you can also get burned a little bit too if you think it's great, and then you're putting money in, because if you look at this right here, here's a good example of that. Here's 5/4/2022. It's like, man, point change was 932 that day. So people are like, oh, good, everything's going to be great. Well, boom, right the next day, we lost 1,000 points. I remember that. That was just a couple of years ago. So it can work both ways. So you got to be careful. Good days and bad days, not making decisions on just days. Remember, I've always said this before, is, focus on decades, not days. But you definitely don't want to miss the next good day. So we're going to have 3 bad days here probably. And but when's the next good day going to be? So you don't want to jump out, because you can see based on these two charts that it can happen, pretty close to the bad day. So don't want to miss that. All right. And then the next thing is that this is a really interesting chart too, the distribution of stock market returns. And you can see this is kind of related to that other one that we were talking about a minute ago, is that they're out of this time from 2026 to 2024, there were 74 positive years and 25 negative years. So, there's way more positive years than negative years, obviously. And sometimes it happens right after the negative years. So up years have occurred much more than down years. The market average gains of 10.2% per year. And 3/4 of the down years were followed by up years. The most recent example is that 19.8% loss in 2022 was followed by a 26.6 gain in 2023. So that's pretty significant. You had this bad year in 2022, and then the next year, boom, a really good year. And that can happen. That could happen this year. Maybe we're going to have a down year for 2025. Maybe we end down for 2025. What's going to happen in 2026? It's going to be another down year, and then another one, and another one, and another one. No, it's going to, like I said on those other charts, don't know where the next positive thing is going to be. But based on history, we can see that sometimes it's not that far away. So we don't want to miss the next best year or the next best day. And this one, this chart's a little busy, but let me just explain this to you, because I think this is really, really important. You have periods of the year where the market is down. But this chart shows that downturns during the middle of a year do not necessarily add up to a down year altogether. So let's look at some of these. Like here's a good example right here. Look at this year where it was down negative 35%. Okay, that's during the year. That's, again, this is 2020. During the year, we had a negative 35%. So you could say to yourself, man, it's going to be a horrible year. We're going to end up, real low, the whole market and everything. Guess what happened? We ended up 21%. Look at a lot of these other down times that were in the middle of a year. So the blue is where it ended up. These things down here, the little red dots, are where it was during the middle of the year. So here's 2024. We actually we were at a -9 at one point in 2024. We ended up 24% up. 2023, we were down 11 at one point during the middle of the year, up 26. Here's a year right here, we were down 7, up 31. So all these time frames show that there are times throughout the year when the market is down, but it doesn't necessarily add up to a down year. And some of the stats there says in 17 of the last 20 years, U.S. stocks ended up with gains for the year. Many years with large intra-year declines saw positive annual returns. So, and then they got this little thing down here. Tumbles may be scary, but they shouldn't be surprising. And a short-term slump needn't mean a full year fall. So, this could be another one of those years. Hopefully it is one of those years where we have this bad little section of the year here, in April, and maybe we will end up positive for the year. So you don't want to bet against that because, that could happen and you don't want to miss that. Okay, so the last thing is the good news is that diversification does work. And there's actually no loss for a 60-40 portfolio in a 10-year period, according to JP Morgan. I'll show you here in just a second. So you may have seen this chart. just about every advisor out there, any financial, place has this chart somewhere in their office. But this basically shows all these little colored boxes are the different types of stocks. So you have, large cap stocks or real estate or small cap stocks or, commodities or anything like that. And then this little gray line, this little box here with the black line going through it, this is a mixture of all those other boxes. So when you diversify, you mix up all these other categories of things, you end up kind of somewhere right in the middle. So you can see, but if you try to pick which one was going to do best, boy, you could really get burned. If you look here, like here's large cap here was the best, but now it's kind of middle of the road. Look where small cap is. It's kind of hovered here, and then all of a sudden, boom, it's in the negative. So some things can really jump up and down. The interesting thing here is look how commodities are always in the negative down here until they're not, until right down here they're like the best. They are really volatile, like all the way down here in the negatives, and all of a sudden, boom, a really good year, and then boom. So you can imagine trying to pick commodities as a thing to just invest in all the time. You could have a great year, and then the next year you got the worst thing out there. Same thing with some of these other ones. They bounce around quite a bit. So you want to blend this together. You want an asset allocation that's blended together that, helps you stay in the middle of all the things that are going, out to the extremes from one end to the other. Okay, and that's diversification. And here's that chart I showed you from JP Morgan. They basically just showed that a portfolio mixture of 60% stocks and 40% bonds. That's the blue bar. The green bar is just 100% stock, and the blue bar is the bonds, and the gray is a 60-40 portfolio. And you can see there that in the green, this is the range that happens in a rolling period of time. So in the 1 year period, the highest that 100% stocks went up was 52%, and the most it went down was negative 37%. For bonds, the highest in a 1 year period, 33% gain, the lowest, negative 13. Okay. And then when you have this mixture of a 60-40 portfolio, then you have the best up to 34% and the worst 20. Now let's go to a 5-year rolling period, which means every 5 years from 1950. So 50 to 55, 51 to 56, 52 to 57, every single 5-year period. If you look at a 60-40 portfolio, it's not even in the negative. So according to JP Morgan, a 60-40 portfolio here over the last 74 years or whatever, has not had a negative 5-year rolling period in that time. So if you're well diversified, 60-40, you're probably not going to end up with any negatives in any 5-year period. All right, that hasn't happened. If you look at the next 10 year, you can see again, there's not a whole lot between the 60-40, between the 5 and the 10. It's hard to see there because it's just a little, I don't know what the actual difference. They have 1% up and 1%. It's probably more than that right there. But on the 10-year rolling period, same thing. The 10-year rolling period for bonds has never been in the negative. And even for a fully stocked portfolio, a 10-year rolling period, the worst it did is, in the negative 1%. Then if you go out 20 years, for everybody who has this long-term, time horizon of 20 years, time is definitely on your side. You could hold a bond portfolio, a 100% stock portfolio, or a 60-40 portfolio. Never been a 20-year rolling period that has been negative. Okay, so diversification works. If your portfolio right now is diversified, and I sure hope it is, then you're not experiencing exactly what you're seeing on the news. You're seeing that S&P 500 go down, the Dow going down. Your diversified portfolio, a 60-40 portfolio, whatever it is you're in, you're probably about half of what's happening there. So just take a look at yours individually and see where you're at, but it's not as bad as what's happening to those benchmark indexes, likely. All right. Okay, so what does this all mean? It means that there's a lot of predictions out there that can be wrong. No one can predict the markets, so you got to tune out the noise. Markets do reward long-term disciplined investors. Remember that. Keep your eye, on the long-term prize of investing. It is good in the long term. Stock gains can add up after big declines. So this is something to really, make sure you don't miss out on that next best day or that next best year, because it can add up pretty significant after some of the downturns. And diversification can lower the volatility, and it's just to help adjust risk, to align with your goals, right? And this is a great Warren Buffett quote. Someone's sitting in the shade today because someone planted a tree a long time ago. So it's basically he's saying, hey, Successful investing is a waiting game. It is something that, it's like watching the grass grow, or it's like planting a tree and watching it grow over time. You will do well with a long-term investment outlook. All right, the market rewards that. Okay, so that's the end of Good News About Investing. I hope that helps you. Like I said before, don't take advice from the news. Use this video as education only. Do not take advice from a YouTube channel, and go out there, find a good advisor, find someone that can really focus on your goals for you, help you with all the things that you're working on for your retirement or whatever it is that you're doing for your investment timeline. And hopefully that some of this good news about investing will help you get through this little short period of time we're dealing with now, and can help you just have a different outlook from what's happening now. Tune out the noise, go for a walk, go for a run, go do something with your family, and it is going to get better. The market goes up over time.